Welcome to the Times of Industry show. Today I'm speaking with a returning guest, a real veteran of the precious metal sector who was bearish last time he was on our show and he nailed it right. Peter Hugg is a Kitcocom analyst, and if you don't know Kitco, definitely go and check it out. He's been in the precious metals market since 1974. That's 10 years before I was even born. So he has been through all sorts of cycles, and that type of experience is invaluable and counts for something for sure. So I really wanted to get his view on what's currently going on. And obviously we see some publications calling this a bear market already in precious metals. Others are extremely bullish, saying it's a buying opportunity of a lifetime. So definitely we see two polarized opinions. Peter, first of all, how are you, sir?
I'm doing well, Lior. Nice to be here again.
Hey, I'm excited to have you on. I want to start off with asking you, first of all, is there a reason to buy precious metals in today's world? If so, what is the purpose for an investor or a saver, for an average person, an institution? What is the purpose of buying precious metals in physical form? And is there a real reason to do so?
I think in today's climate, I think it's even important to have a portion of your portfolio in gold or in some kind of related commodity asset. You know, whether it's gold, silver, or some of the PGM metals, platinum, palladium. We've also been very bullish on rhodium for the past 2 years. We still see considerable upside on the rhodium price, even though it's moved from $700 to $2,300. We think $3,500, $4,000 number over the next 2 years is certainly a real possibility. That's based on a supply and demand. But to your question specifically, it really depends on the motivation of the client. I mean, you know, what the reason is behind why you would buy gold, and there's obviously a number of reasons. One, you treat gold the same way you would treat anything else in your portfolio. You know, be it Apple stock, 10-year bonds. Real estate, are you in the game specifically for a capital gain, and what's your time horizon on that capital gain? Are you in the game because you want a percentage of your portfolio hedged in case we have a situation similar to the financial crisis of 2008? Or are you basically in the game because you believe that the financial system it's just a matter of time before it collapses, and you want some liquid assets, basically from the perspective of protecting your overall well-being. And that third group tends to buy physical gold, is primarily physical gold buyers. They tend to take delivery. They tend not to buy ETFs or mutual funds or hold gold with dealers. They have a basic distrust of the system, so they tend to take physical delivery of the gold. The first two scenarios, if you're buying gold for capital gains, even though this market's been on a downtrend, basically, for the past 2 years, there's been many opportunities where you could be in and out of this market and trade effectively and make money. And from a hedging perspective, holding gold in your portfolio, as long as you recalibrate that position every 6 months, it still makes sense, in my opinion, to hold gold as a percentage of your portfolio. I think there's considerable risks in the global economy, and I think they're growing, quite frankly, on a daily basis, especially in the Middle East, with issues such as Turkey's liquidity. That could have some serious impacts on the European banking structure, which could create contagion to the U.S. financial system. You obviously have the issues with the trade war, potentially between the U.S. and China accelerating, although this morning they suggested they were going to have further talks. So there's a number of issues out there on the immediate horizon that suggests owning gold would be a prudent maneuver, at least as a percentage in your overall portfolio.
Okay, so just to recap this, one reason is a geopolitical reason. Gold is international currency. It's not related to any one political state. Obviously, people in Turkey and in Venezuela that are holding gold are enjoying the fact that they own gold, whereas people in the U.S. do not. But overall, if you have an investor mindset that is international and you fear political instability, and secondly, the fear of higher inflation or higher interest rates coupled with tax cuts, which make no sense financially for the federal government. So that's clearly understood. Obviously, making sure that you calibrate the position size, because I've heard over the years people that say put 100% gold, the world is going down, everything like that, and obviously the world doesn't go down every 5 minutes, so it's important to be really balanced. Sometimes when you just listen to alternative media, you get as biased as you do with mainstream media, and that's important to understand. Peter, has the dollar proven that it is, and no doubt, the best fiat currency in the world we live in right now?
If you're asking the question from a time frame of right now, the answer to that would be yes. I think what people are getting confused with, or maybe have not really done the research properly, is, you know, they look at 2008 and say, my God, gold took off because there were financial strains. Obviously, there were more than financial strains, but there were serious issues in the financial markets, not only in the U.S. or North America generally, but also in Europe and in the Far East. So they look at the Turkey situation right now, where the currency is under serious pressure. It's debatable whether Turkey, they certainly can't currently pay their debt obligations, so they may be going to their only recourse is to go to the IMF. Unfortunately, the Turkish government and the American government are at odds right now, and the U.S. has a veto on any IMF loans. So it's not a done deal that the IMF will be able to grant Turkey the loan. But the European banks are heavily exposed to Turkey. So the logic would be, while there's potentially a financial contagion happening in Europe, you should be buying gold. But if you look back historically at 2008, when the financial situation started to deteriorate, gold actually dropped 20%. It wasn't until, and the reason that happened was because the first reaction when you have this kind of financial contagion is money tends to go to currency safe havens. And the two currency safe haven plays are the US dollar and the Japanese yen. So you've got a situation when the fear first starts to surface, money will flow into US treasuries. It seems to be the comfort level for international investors. As the U.S. dollar then appreciates, it puts a negative slant on the commodity market, which is what we've been seeing over the past few months. And it wasn't until the Federal Reserve back in mid to late 2008 started ratcheting down interest rates to zero that the dollar started then to depreciate, and that was basically the launch pad for gold that took it to the highs of $1,900 in 2011. This time around, you have a similar thing occurring with sort of the Turkish issue, but the other issue that has basically been benefiting the dollar is you have the Federal Reserve on an upward slope on interest rates. I don't believe that they are going to raise as much as people or analysts right now are anticipating. I think they may even hold off in September because the stronger dollar is really affecting these emerging economies because their debt is denominated in dollars, and as interest rates rise, they can't service the debt. So it could be the Fed takes its foot off the brake. But in the interim, while the Fed has been raising rates, the ECB has been indicating that they are going to stay on a very, very loose monetary policy at least until the spring of 2019. And in that context, you have spread yields between the dollar and the euro widening. And that's also creating capital flows into the U.S. Dollar and into the U.S. stock market, which is strength in the U.S. space, and as a result having a negative impact on the commodity space. That's why the last time we spoke, I was taking more a negative slant on the metals markets, and so far I haven't turned the corner yet. I'm not turning into a raging bull, but I'm thinking that we're fairly close to the bottom here because I think the Fed is going to have to sort of relax its tightening policy. Otherwise, it puts the rest of especially the emerging economies at serious risk.
Well, and we have a number of interesting things here to consider, and it's a great topic. And between 2004 and 2006, when the Fed raised rates, gold outperformed stocks severely, or positively, I should say. But right now, the interest rates are being hiked along with the fact that the Fed is tightening the monetary supply of dollars. So it's a different scenario this time around, and it's putting a different environment on the precious metal sector. So it's definitely a unique time. It's a bit trickier to decide what the fair price of gold, the spot price, is, but it is much more self-evident to evaluate mining stocks individually. Are they cheap right now, or is the downside risk still huge in your opinion?
Again, again, when I look at mining stocks, I mean, there's two. I mean, if you look at silver, we do on Kitcocom. There are a large amount of mining companies that advertise on Kitco.com, and we've had yesterday. We actually got some panic calls from some of the mines that produce silver because some of their production costs are sort of close to where the price is right now. So there is some concern of their profitability. I tend to stay away from the juniors that do not have possibilities of near-term production capability. I always get slammed when I go to conferences and talk negatively about the juniors, but I consider junior mining companies that basically, they've leased some land next to somebody that has actually found gold or silver. They do a few drill bits and they say this is how much estimated reserves we have, but they have no capital. So they have to keep coming back, diluting their shares, hopefully drill a hole. And, out of 10 juniors that do this, maybe one actually gets to production. The rest are hoping that they can prove enough reserves on their property that a major will take them out, and that way they'll get their investment back on their capital invested and for their stockholders. If you're looking at majors that have production and have positive cash flow, I think you're still okay with with the Barricks and the Newmonts of the world at these levels. Should gold get down below 1,050, then I think the cash flow situation on these, even on the majors, certainly they're going to cut any dividends that they're paying now, it becomes a bit more questionable. So at these levels, I still like them, but again, it is basis overall, what do you think the price of gold is going to do? I mean, these things sometimes lead the gold price. Right now, they're not indicating that they're yet ready to do that. But if you've got a major gold mine that is paying a dividend and you like gold generally, I think at these levels you can consider adding to the position or buying a position if you're not in the market yet.
Well, and obviously the best thing to do in hindsight was to just sit on the royalty companies, which have done fantastically well.
Absolutely, and the streaming companies as well. They've done extremely well.
Now, you speak with CEOs all the time. Are companies in distress right now, or do they have enough cash to withstand for years? Is this looking like 2015, or is this just very mispriced companies that actually have some good fundamentals in terms of their balance sheets, and they're just trying to weather the storm?
Again, that's the analysis. You need to look at the company. You have to have some comfort in the management, but you want to look at their cash reserves, because in a falling market like this, the psychology of raising capital is extremely difficult. When you've got an upward slope in the prices, it's much easier for a junior if they need to recapitalize to issue more stock and generate cash in the bank. But in a falling market, the psychology of going out to on a private placement or a secondary offering is much more difficult, and investors and brokers are much more careful in getting their clients involved in a secondary offering to raise cash, unless the fundamentals are absolutely fantastic, where they've got proven gold reserves and they just need that extra bit of juice to get over the hump. But for mines that are still sort of in the exploratory stage, they got a couple of drill holes down and now they run out of capital. I think these companies at these levels of pricing will be in distress. The majors, I'm not concerned. I'm not concerned about at these price levels. They're still making money at $1,180 gold, so there I'm comfortable. But again, it's the juniors that I'd be a bit wary of, and before I would take a secondary offering, unless I was totally betting that this market was at a bottom and it was going to reverse, I would be a little hesitant to put money into the deal. So. It's hard to say yes or no to your question, but that's sort of how I would evaluate the overall picture.
Interesting. Now, you speak with CEOs all the time, like I said, and I want to know what the greatest challenges for the miners are right now in terms of, from the exploration plays to the development stage up until the operating miners. What do you see as what are you hearing are very important challenges and risks that they're trying to offset?
Well, the biggest challenge is liquidity and cash flow, and being able to continue with their process as they get to or potentially strive to get to production. And it's challenging in this market to raise capital. So their concern is that if they don't have some juice in the market, investors start to get discouraged, which has obviously been is a common theme in the investor market right now in the precious metal space. That raising that capital is going to be extremely difficult. So that's their primary concern. So where they can cut their expenses, they're cutting their expenses. They all believe that this market drop is temporary, and that metals trade in a cycle, and eventually, a lot of analysts. I take a lot of my lead on where I think precious metals go by what I hear and speak to in the foreign exchange market. The foreign exchange market is the market that knows what's going to happen. It's a $3 trillion a day market. That is where the sensitivities to world economic issues and all that play out. And a lot of analysts that I respect think that this dollar strength that we've been seeing probably will start to run its course by fourth quarter this year. And if that's the case, then I think we're looking at a bottoming process in the metals complex somewhere between now and, fourth quarter this year. And if that's the case, then at least we have potentially set a floor. The problem with setting a floor is you can set a floor, but that doesn't necessarily mean you're going to all of a sudden shoot to new highs. Between 92 and 2002, we set a floor on gold roughly in the 350 range, and it stayed there for 10 years. So the floor can stay there for a long time, but the downside pressure would be gone. But if you had a floor at $1,200 and you could produce even at a junior level gold at $900, at least you've got a profitable mine, so you can still make money and return value to your shareholders. So we're looking for that floor. I think that floor is within the next 3 months. If we haven't already seen it, I think we're close to the floor. I think maybe another $50 down on gold, I would definitely be much more aggressive.
Now, Peter, what about futuristic metals such as lithium, cobalt, nickel, the ones that are necessary for the booming electric vehicle market and for other industries that are very, very robust in the 21st century, especially going into this third decade of the century?
I like all of those metals. It's a matter of how you can invest in them and what kind of liquidity you can get in the markets. Again, it's all going to be premised on global growth continuing, and that is a question mark. We could be coming. We've basically had growth now for the past 7 years on a global basis, albeit a little anemic in the European theater. At what point do normal cycles take hold, and the next sort of cycle is a recession, which is possible if the Fed gets a little too aggressive with their interest rate increases. But just to give you an example on rhodium, we went long rhodium at $700 an ounce back in 2016. We put out a buy signal. And it wasn't because we were particularly enamored with rhodium, but we were looking at rhodium as a metal that was obviously used in catalytic converters, and we saw that the economic recoveries in the U.S. and to some extent in Europe and in Japan were starting to take hold, and we expected that consumers would buy more vehicles, and that tended to play out, and rhodium moved up to about $1,200-$1,400. Our target when we issued the buy at $700 was actually $2,300, and where it is today. And what we looked at was the issue that came out with Volkswagen a couple of years back when they had that issue with their diesel engines and their emission fraud that they were reporting. So the global community, China included, China's a little slower in this, but they're going to catch up, are moving away from diesel engines. And diesel engines generally use more platinum than palladium or rhodium. Now, as you move away from these diesel engines into the hybrid vehicles, there is more need for palladium and rhodium in those types of engines. Now, palladium, as you can see, is basically trading at a premium to platinum of almost $100 right now, but palladium historically has always traded at a $200-$300 discount to platinum. So palladium demand is increasing, and as global growth, if it continues, we continue to like palladium from a supply-demand perspective. Rhodium is even a better play because rhodium is a byproduct of platinum production, and there's been some serious platinum production issues in South Africa. There's been strikes. There's been less demand for platinum because of the diesel engine issue. So as a result of less platinum being mined, especially at these levels, which makes it virtually not very profitable to mine at these levels, you have less rhodium coming onto the market, and that's why you see rhodium where it is today. And some analysts we're speaking to, especially from the Far East, are expecting rhodium to potentially pop. Not to $10,000 like it did in 2006, but certainly they think it's got another $1,500 to $2,000 in it.
That's interesting, and it's a very unknown metal to many investors. So it's worth taking a look at for sure. And I have.
And you can trade it, though, Lior. You can trade it. There are ETFs in rhodium, and there are also a number of other ways to invest. You can buy physical bars. There's a brand new coin just came out 2 months ago, the first rhodium coin in the world, made by the Perth Mint. So there are ways to buy rhodium in physical form or in trading accounts or in ETFs, which are not available on some of the other more esoteric metals.
That's interesting. And definitely look at Kitco for more information on that. And I want to ask you, Peter, royalty companies, going back, streaming companies such as Franco Nevada, have been unbelievably good investments, even in the worst of times. I bought shares of FNV, of Franco Nevada, when it first started trading. I've owned them ever since. It's one of those amazing investment stories, and it's a one push of a button, and you get exposure to such a terrific opportunity. Obviously, today's prices is not, and today's valuations are not what they used to be. But is it a must-own stock in general when the price is right?
I love Franco Nevada. One of the principals, I won't mention his name, goes way back to my previous life when I worked for the bank in Toronto, Canada. He worked for us, and he then he helped us manage portfolios in commodities, and then he moved on to Franco Nevada, and he's I won't give you the name, but both the two most senior people in Franco Nevada I've known since the late 70s. Both of them are extremely good businessmen. very, very sharp. They know what they're doing, and they tend to be very calm individuals. They don't tend to be, out there sort of, hyping anything. They're just very, very smart businessmen. And as far as the management team goes, I don't think there's one better on the planet than the one at Franco Nevada.
Interesting. Great compliments. I want to ask you, do you think silver will ever be considered monetary in our lifetime again, or should we expect the ratio to hover around the 60-1 from now on, with silver not getting any premium for being a monetary hedge, and it's just trading like an industrial metal?
No, I actually liked silver in this bear market, but I've liked it in a certain context. I've liked it as a ratio against gold. So whenever the silver ratio has gotten above 80 ounces of silver to an ounce of gold, we've recommended trading the ratio by selling gold and buying silver. And you can do that in the futures market. They actually offer a contract where you can trade the ratio. So there is a vehicle now for investors to be able to trade the ratio. It's difficult to do that on the cash market because obviously you'd have to be able to short gold on the cash market and buy silver. Buying the silver is easy, but it's difficult to short gold on the cash market. So you basically have to do it in the futures market. And that's played up pretty well. Every time it's gotten over 80-1, we've looked at a target of anywhere from 74-1 to 76-1 to close out the position. We're in that position now. We are long silver against gold. So, and the reason I like that trade is because if gold takes off from here, I mean, if we've seen the bottom, and by take off, I don't mean goes to 1900, but gold just goes to 1300. That's really only about a little over a 10% yield in gold. But I can tell you, if gold goes to 1300, silver is going to be at $18, which is about a 30% return. So if gold goes up, I think silver outperforms gold. If gold doesn't go up, I think, and you play the ratio, and the economies continue to do well, I think silver, because of its industrial component and demand, will increase because uses for silver will be increased because of the global recovery. And in that context, the ratio will also narrow in silver's favor. So I like the trade either way, but I think if we do get another issue where gold takes off for either geopolitical reasons, financial reasons, or inflationary reasons, I would still be into silver at $14.70 as opposed to gold at $11.80. From a percentage return basis, I still like silver.
Now, obviously, one of the themes that I look at is the correlation between gold performance and stock market performance. So, in my opinion, the gold performance will start doing well when stocks stop doing so well. So that's where I'm at with this whole scenario, and that's why I am very cautious regarding mining stocks, regarding gold bullion, and regarding making any big plays in this sector, because the safer environment, the safer investments that are actually better long-term investments have been so good. And I want to ask you finally, have we hit peak gold?
Have we hit, pardon? I didn't hear the question again.
Have we hit peak gold? There have been talks from many CEOs.
Yeah. I'm trying to figure out how to answer the question. It's hard to answer that question, yes or no.
Here's what we know. We know that the production by 2024 will be halved what it is today. So.
Well, let me. Can I stop you there, Lior? How do you know that's a true statement in China? And how do you know that if we don't work something out with China, that China with their gold reserves there, and nobody has been able to quantify that, but they consider them massive, it doesn't start to become a gold exporter? I mean, that's the only thing. I'm just not sure. based on the Western production levels of gold and the African production levels of gold and even South American limited productions of gold, we can make an argument that we are at peak gold. But China is the unknown here, and I just don't know what's in the ground over there and how much is still yet to be discovered. And if they do become a true international trading partner, as opposed to what the games that they've been playing, do they then become a gold exporter? That's just the unknown element in that for me to be a little hesitant on saying, yes, we're at peak gold.
Sure. And obviously the question was towards the public companies that report and the private companies that report, not the quasi-governmental companies in China or just the private companies in China that withhold many key information. I want to ask you lastly, where can people check out more of Peter Hug, what you're doing, what are you up to, and what does Kitco do in general for listeners?
Well, again, as you know, Lior, from our last conversation, I try to be as transparent as possible, and I'm certainly, when I go to conferences and speak, or I speak on financial networks, you'll never hear me call for the end of the world. I'm just not one of those analysts or traders that tries to get people involved in an investment by scaring them. So what and again, this is not an advertisement for Kitco, but what I find very, very refreshing with Kitco, because quite frankly, I came out of retirement to help the owner of Kitco with their precious metals operation that, basically had grown from 10 people to 220, and he just needed some help, is that the Kitco.com site really is unique in the metals industry. You can go to other dealers and, they've got their promotions up and they're, they're saying, you got to buy now, you got to do this, you've got to do that. And it's not that Kitco doesn't promote their products and suggest that there are times to buy and times to sell. But if you look at the Kitco.com site, there are 30, 40 commentaries posted daily. And some of them are bearish, some of them are bullish. Some people, and these are people in the industry that give reasons why they're bullish and bearish. And it's an excellent website for people that aren't really pros in this market, but want to understand better what the fundamentals are and technicals are that move the commodity space. It's an excellent learning website, so you can read and understand what the professionals are saying out there, and at least it gives you a basis of information so that you can make an informed decision, as opposed to, going to some conference where you got a guy up on stage that's been saying for the last 30 years that the world's coming to an end. And eventually the guy's going to be right, but likely not in our lifetime. But you're always going to be right somewhere along the line that the world, the financial system is going to collapse and we're going to have an issue. But that's all they say, and they say it all the time, and they've been saying it for 20 years. This is at least informed. You can think it through yourself. Look at the risks. Determine whether you want a percentage of your portfolio in gold. And if it doesn't make sense to you, you don't do it. I mean, you don't always have to own gold. At times it makes sense. But it's important to understand and to learn. And that's one of the things I think that Kitco offers. It gives clients the ability of at least educating themselves.
Hey, Peter, thank you very much for taking the time today. And we'll definitely catch each other in the future.
Thanks, Lior. It was a pleasure being here again.